Okay, good evening, Marshall Reddick investors. Thank you so much for joining us this afternoon for a really exciting webinar and topic. My name is Daniel. I'm a real estate advisor and realtor here at Marshall Reddick, and I'll be co-hosting along with our VP of Private Lending, Patrick Prunty, and we're going to be talking about the Indianapolis market and hand-selected, freshly renovated, tenant-occupied investment property in Indianapolis. These are going to be what are considered turnkey properties, very desirable investments, ones that I personally favor. Really excited to share them with you this evening.
Yeah, awesome. My pleasure to be here with everyone tonight as well. This is Patrick Prunty speaking. And as we get started, to reiterate what Daniel mentioned, we're going to be diving in heavily into the Indianapolis market, why we feel here at Marshall Reddick that it's a desirable market for rental property, and talking a little bit specifically about the turnkey rent-ready system that we've created. As we get started, little fact information here. Not many people understand the nickname Circle City and how Indianapolis got that. So thought I'd share that with you. This is it. So this is this is Monument Circle, used to be called Governor's Circle. It is the center point of the planned city of Indianapolis. So the plan, most cities actually aren't planned. Indianapolis was master planned, and the plan's known as Mile Square. It's bounded by east, west, north, and south streets, centered here again in Monument Circle. So it's a very cool area. I visited Indianapolis several times in my travels. I own investment property there, and happy to share all of that information with you folks tonight. When I look at an investment market, I'm very much a numbers-driven investor. So one thing I always like to look at is a historical glance back. And one of those metrics I like to look at are single-family home median sales price. So we utilize the data as provided by the National Association of Realtors. And on the screen here now, you can see the last 25, 30 years of that median priced single-family home. So as you know, hindsight's always 20/20. I certainly think that we all wish that we would have invested back in the 80s or the 90s or even the 2000s. But you can see really what I'm grasping from this is how steady of a market Indianapolis is. With few exceptions, we're positive nearly every year. 2008, of course, every market had a little bit of a dip, but even at less than 8%, we're not even close to some of the boom and bust markets like California, Arizona, Nevada, Florida, etc. So again, the idea that it's a very steady market is something that drew me to it, and a reason why we here at Marshall Reddick believe in Indianapolis as a great area for investment property. In terms of how that looks in graph form, again, just to reiterate, very steady. Some of those boom or bust markets are very volatile, and timing becomes extremely important in terms of when you buy. Indianapolis and some of the Midwestern areas are not susceptible necessarily to timing necessarily, especially for buy and hold investors who are going to be looking to hold for, minimum 10, 15, even to 20 and 30 years. So the average annual appreciation in Indianapolis Metro coming in at just over 2%. So pretty solid numbers. I think Orange County over the same time frame, or Los Angeles County, is running close to 5%. So, not a huge difference, and again, very steady. Let's get on with the poll question as we dive into this tonight. We love participation by those of you guys with us tonight. So let me get this poll launched and we'll get some feedback. So if you wouldn't mind helping us out, you decided to join this Marshall Reddick webinar tonight because, so take a few minutes and give us your answers. Thank you so much for the feedback. We're getting a lot of response. We got quite a few of you on the call tonight, so we're going to give maybe 15 seconds and publish these results so that everybody can kind of understand who's on the call and why they're here and that type of thing. All right, just a couple more seconds. Okay, we'll go ahead and close that poll and share the results. So as you can see, majority of the folks here tonight are interested in learning or interested in rent-ready turnkey investment property. Perfect. That's exactly what we're going to be discussing tonight in the market of Indianapolis. And then the other high percentage there, 36%, just interested in Indy in general. So you came to the right place. Again, thanks for joining us and thanks for the participation.
Okay, a little bit about Marshall Reddick Real Estate for those of you who are joining us for the first time, and we're so excited to have you. Marshall Reddick Real Estate, we have 3 primary branches. We do not just sell investment property. Myself as a real estate advisor, of course, I help clients invest in real estate in all 16 of our markets, but I'm also a realtor and I help individuals buy and sell property here in Southern California. We're also a property manager, so we manage our clients' properties and portfolios directly here in Southern California, in the Bay Area, in Austin, Texas, San Antonio, Texas, and soon to be Clarksville and Oak Grove, where we're actually opening our 3rd office. And finally, we are a private money lender as well, offering those loan programs for both our clients who are looking to lend money and borrow hard money.
Awesome. Yeah, thanks so much, Daniel. It's important that everybody understand definitely our intent. You're going to be seeing new Marshall Reddick offices pop up all around the country. As Daniel mentioned, you know, our corporate home office here in Newport Beach, but a new office in San Antonio as well as Austin, and the forthcoming newest office to be in the North Middle Tennessee market of Clarksville.
All right, a little bit about myself first and foremost. I've been with Marshall Reddick Real Estate since 2016. Already mentioned real estate advisor and realtor. My role is really working directly with clients to evaluate their short-term and long-term real estate goals, help them put the plan in place to achieve them, introduce them to all the key players in the transaction, really quarterback A to Z. My background previously was in construction and development, so really have experience in all aspects of real estate.
Yeah, thanks, Daniel. And my name's Patrick Prunty, I already mentioned. Just to reiterate for Daniel, he's going to be your point of contact on the disposition. So you folks that are interested in buying those investment properties, whether they're our turnkey properties that we own, that we've renovated, that we've placed tenants in, and that are now offering them to sale for you, or whether they're straight off the MLS, or whether you choose to buy your own distressed properties and fix them up, Daniel's going to be on that dispositions end. My role here at Marshall Reddick is really going to be on the private lending side, and most recently on the acquisitions and somewhat wholesaling side. So I am the one in the trenches making offers on properties in Indianapolis and several other markets that we offer this turnkey type program, handling those acquisitions, managing the renovation, and then making sure that our dispositions team, headed up by Daniel, is aware of what's going on, and then we commonly do these webinars together. So that's your power team here at Marshall Reddick in terms of dispositions and acquisitions.
A little overview of everything that's going to be covered tonight. First and foremost, we're going to be talking about what makes Indianapolis an attractive metropolitan area to invest in investment property in any case, because certainly we wouldn't be highlighting the market if we didn't recommend it as a metropolitan area that's going to be beneficial and profitable for you all as investors. We're certainly going to be talking about financing, different methods available to you as an investor to acquire investment property, not just conventional, but also private channels as well. We're going to talk about the rent-ready system, what sets a turnkey investment property apart from a standard resale, how they differ, what benefits there are to you as an investor for pursuing a turnkey property. The importance of property management, certainly, and the property management company that we work with directly in Indianapolis. Insurance and asset protection, why that's beneficial to you as an investor, why that's necessary to you as an investor. And then we're going to take a look at some actual inventory currently available in the Indianapolis market today.
Yeah, as far as the rent-ready system that we're offering here, let's dive into that just a little bit to make sure that everyone's clear. So the bottom line here is the goal being providing the clientele, so those trusted investors who followed Marshall Reddick over the last 40 years we've been in business, providing a controlled inventory, rent-ready homes located in fantastic, great neighborhoods, good schools, properly screened tenants and trusted property management in place before you close escrow. Okay, so we accomplish this with a number of fashions. Number one, we have a great team in place, and we're going to talk about all those players that are in place. We understand the local market, and we do that because we've invested in the market, right? We've been there for many years. We've been through the cycles. We've been through different property managers. We've worked with different real estate agents. We've examined different neighborhoods. Right? We understand what works and what doesn't, because there's a lot of garbage that's out there, right? There's a lot of bad neighborhoods. There's a lot of no-fly zones that you don't want to invest in. And if you've got the time, right, to invest the same 40 years that Marshall Reddick has, certainly you can do that. But a lot of clientele has reached out and desires the turnkey model that will really make the investment a little more passive and allow you to collect rental income from day one and have a good experience with low maintenance and low vacancy. So again, we're targeting good neighborhoods. We are buying these properties. So we own them, we stabilize them, we renovate the properties, bring them up to rent-ready standards. Oftentimes that includes new roof, new mechanicals, or carpet, flooring, paint. Each property is a little bit different, but again, they're going to be in a position where obviously they're rentable and to where the new owner coming in that's going to be the 15 or 30-year hold is going to have that rent-ready low maintenance factor. So we obviously are going to be screening and selecting the best tenants on the front end and having the property management in place. And the bottom line is that then we bring these hand-picked, rent-ready, and now tenant-occupied properties exclusively to Marshall Reddick clients. We do not list these on the MLS, right? We do not list these anywhere else. These are specifically for our clientele. And again, not all clients want to buy the turnkey property, but those of you who are looking for it, we do this in Indianapolis as well as several other markets in which we operate. Just as a point of reference, this cute little property here, this is on 36th Place. This is the first property that I, Patrick Prunty, purchased in Indianapolis. So pretty standard of what you're going to get there. I try to focus on newer properties. I believe this one was probably 60s, 70s, but I used the same channels to have the property renovated and brought up to rent-ready standards. So got those relationships with the contractors in the market to be able to transform it into a beautiful property just like you see. This is just a quick snapshot of the pro forma of that particular property that I mentioned. This is going to be a little bit lower on the price point than what we are showing tonight, but and at the lower end of what we're looking to buy in Indianapolis. We really aren't going to buy anything for the turnkey program, and we're really not big advocates of clients like yourselves buying investment property with rents of under $800 a month. So this one at $815, it just makes the cut. And we'll get into a little bit more as we progress down what we're looking for and what we're targeting in terms of property for the rent-ready program.
I want to highlight very quickly here. Patrick may just mentioned this is a C-class property, lower price point, and a lot of you, especially those new to us here at Marshall Reddick Real Estate, may be asking, well, what is a C-class property? What's a B-class property? What's an A-class property? And what do those mean? All of that information is included in what you're seeing in front of you here, the Reddick Property Rating ebook. This is a very comprehensive guide to choosing the best real estate investments for your short-term goals, your long-term goals, and how to ultimately structure a portfolio relevant to yourself. And there's a lot of tools and metrics within this book that I highly advise using in determining the best investments for you. Here you'll see the Reddick Property Rating Scale. One thing I want to highlight to all of you on the webinar right now is that what we're saying here is that the median home price in Indianapolis is $171,500. What that means is every property in the Indianapolis metro listed above this $171,000 price point falls in the A-class category. 80% to 100% of that value is B-class, and 50% to 80% of that value is C-class property. These are going to determine the types of tenants you have in the property, the types of returns you can expect, and ultimately the experience you have owning this investment property.
Yeah, one of the big points about the heat chart you see here in the class system that you'll find in the Reddick Property Rating is the fact that we actually have a methodology that assigns maintenance and vacancy factors to the classes. So the nicer the property, therefore the higher the price, the nicer the tenant you're going to have, and therefore the lower maintenance and the lower vacancy costs. And as you move down the price point and down the heat chart from B to C and then into D, you're going to increase your maintenance and increase your vacancy costs, right?
And one thing to note there as well, Patrick, is that every metropolitan area is going to have a different scale because every metropolitan area has a different median home price. So while a $170,000 property is going to essentially be on that A-B class border in Indianapolis, it certainly is not going to be here in Southern California.
Absolutely, good point.
I want to go over very quickly the process in working with us here at Marshall Reddick Real Estate, specifically in working with myself as your real estate advisor. It really starts with an initial phone call, opening up the dialogue between yourself and myself, and really getting to know what it is that is motivating you to invest in real estate. And I keep mentioning short-term and long-term, not only for your first investment property, but down the line as well. And once we really are able to draw up an outline, we can look into the options available to you. That includes financing, markets available, markets within your price point, and that really fit the returns you're looking for. We're looking to quantify your returns, both short-term and long-term. We'll discuss time frame, and all this initial dialogue also includes criteria that's important to you, not just in the metrics and your returns that you're looking for, but in the property specifically as well, whether you're looking for single family, multifamily, C-class, A-class. Each investor is different. Each investor is looking for different returns, a different type of investment. And ultimately setting that criteria going to help us land on a market specific to you. And we always say here that where you invest is not as important as who you work with. And here at Marshall Reddick Real Estate, we have very carefully vetted and experienced teams in each of our markets to help you, like I said, from point A to Z.
Yeah, and it's a relationship thing, right? So, for those that are first timers or those that are very experienced, right? You want to have that relationship with your real estate advisor forever, so that when it comes time to sell the property, you have a point of contact that can get you and the people to do that. When you need to be on a 1031 exchange and then getting into the exchange properties and all of those more sophisticated things that come with experience and with relationships. So take the time to build one with a real estate advisor.
All right, I just mentioned that who you work with, more important than where you invest. And specific to this webinar today, specific to these turnkey investment properties in Indianapolis, this is really your power team. It starts with Patrick and I. Getting to know myself as the advisor, Patrick, and helping provide this hand-selected, rent-ready turnkey inventory.
Yeah, we're providing deals, you guys. I mean, a lot of investment firms that are out there, are they really providing deal flow? That's something that's very good about Marshall Reddick. We're always giving you those opportunities, right? And when it comes to the local market, we have the agent involved the whole time. You have representation. So when you're buying a turnkey property with us or not, Christopher is going to be that local licensed real estate agent in Indy Metro who is going to be your independent representation. Right? Mike Taylor with Red Door Property Management. You certainly don't have to use Mike with Red Door. You can use any management company of your choice. We've just been through many, and we believe that Mike Taylor offers a superior product at a superior price. We're going to get into them a little bit more. In terms of conventional real estate financing, you got to work with Reed Hazard. You don't have to, but he knows the game. He understands how it works with Marshall Reddick, and he's going to get you to the best end, which is you closing on that awesome investment property or investment properties that are going to help you leverage yourself to long-term wealth. And Stan, he comes in to help you to protect those assets.
Part of the process here and working with us here at Marshall Reddick Real Estate and investing with our team is working with an individual on the ground in Indianapolis who's going to be your regional rep, your buyer's agent, represent your interests, whether it be for a turnkey property that Marshall Reddick owns or whether it be for a standard resale. And this is our regional rep in Indianapolis, Christopher Haven-Jones. Christopher, I consider a close personal friend, but he's also one of the most knowledgeable and professional realtors I've ever met. And like I said, he's going to be your boots on the ground. He's going to be negotiating on your behalf, attending your home inspections, and really a very important team player in the transaction. And then Mike Taylor, your property manager, owner of Red Door Property Management, incredibly professional property manager, manages an entire portfolio of Marshall Reddick client properties, provides a discount to Marshall Reddick clients. You know, being a property manager ourselves, we can spot the poor property managers from the great ones. And Mike Taylor, like I said, very professional, very knowledgeable.
All right, so let's dive into Indy. So just to brush up on our geography slightly, there it is, smack dab in the middle of the state of Indiana, smack dab in the middle of the Midwest. I always need to brush up on my geography from time to time. So, and then diving in further, we focus a lot of our data on metropolitan statistical areas. So our circle here encompasses the Indy metro area, which includes the cities of Anderson up there in the northeast, Carmel, which is like the Beverly Hills, along with Fishers right there next to it, Beverly Hills of Indiana, and then, of course, the anchor city of Indianapolis. And again, the government provides a lot of data on metropolitan statistical areas that we use in examining a lot of the markets in which we choose to operate. So again, being a very data-driven investor and a very data-driven company here at Marshall Reddick, I always like to get into population, and I love to compare to where most of us live locally here in California, as well as to the U.S. as a whole. So I was a little shocked to see that Indianapolis at 900,000 in terms of population is the 16th largest city in the U.S. And that the population of the total metro area that again includes those cities I just mentioned is the 34th largest in the U.S. So pretty large city. And then as you compare that in terms of some other metrics and some other demographics, median age pretty similar to here in LA and pretty similar to the US. The household income was a little bit of a shocker, right? So Indianapolis at 56,750, not that much lower than here in LA. But you know, compare that to the cost of living and the cost of rents and the cost of property values, it's a staggering difference. We're going to talk a little bit about that and why that's going to continue to drive population to areas like Indianapolis for the younger generations coming behind us, as it's affordable. The median single-family home sales price, again, we mentioned and showed that earlier on that 171.5 is, as of the end of 2017, the median single-family home sales price in Indy. Compare that to Los Angeles Metro at 5.5, or the U.S. at almost 2.5. Unemployment, super low, much lower in Indy than it is in LA versus the US. And the price to rent ratio, very important metric that I follow. Indy's off the charts at 15.35 versus Los Angeles and the United States as a whole. Always like to use my sources as well, so you'll find those at the bottom of the slide if you'd like to do some research on your own. So let's talk about that price to rent ratio that I mentioned. So in essence, I like to think of this as you get more bang for your buck when you have a lower price to rent ratio. So I've got the general formula on the screen for you, and then you can also see again as I compare it to Los Angeles and to the United States. So the lower the price to rent ratio, the lower to zero, is going to mean that the lower the price to collect more rents. Okay, and so the first math formula there, basically the 16.675 or 16.67 means sort of 12,000 a year rental, so $1,000 per month is a $200,000 price point. And then as you move down there, you can see again as that I apply it. So in essence, on average, in Indianapolis Metro, $1,000 a month rental is going to be somewhere in $184,200. Now we strive to beat that, right? But just as a comparison, you're definitely getting way more bang for your buck investing in rental property in Indy as opposed to the U.S. as a whole, and certainly in Los Angeles Metro, where you can't make cash flow even if you put 50% down. Another metric that a lot of folks don't look at that I do is the price to income ratio. Now this is different than the price to rent ratio. This is price to the median annual income, median annual household income, okay? And I was shocked in my research to find that a historical rule in a healthy economy that the home you buy should equal roughly 2.6 years of your annual income. And it just made me, shocked. We're so out of whack here in the coastal areas, California, and then over on the East Coast. The property values are so astronomically high compared to our median annual incomes, but not in Indy, right? So basically a 2.67 years of income would mean for a $200,000 purchase price, your annual income should be about $75,000. So in Indy, you're getting pretty close there. Again, the average single family home, 171.5 versus their incomes at 56,750. So the surface, it might not necessarily seem that this is that applicable, right? Because then it's like, are people going to be buying homes there? But that's not the case. I look at it as a huge draw for population, and that's why areas like Indianapolis are going to boom over the coming years as the younger generations can't afford to live in the coastal areas and are forced to move where there's jobs, right, and where they can afford to live. So keep that in mind over the next 5, 10, 15 years. Test out what I'm saying. I think you're going to find it to be accurate. As far as a thriving and diverse metropolitan, I like the fact that Indy's spread out, right? So we've got definitely high in healthcare, a lot of hospitals in the area that are big employers. Manufacturing, still obviously big. Historically, it's been big in Indianapolis. And that's transforming now. That's changing. So you're going to see that manufacturing block at 12.1 going more into the technology sector. And of course, education's huge. And that's kind of why Indy has this great thing happening, because it's got great education that's taking some of those manufacturing jobs and turning them into technology jobs, as large tech companies, mainly in coastal areas like California and East Coast, are pushing into the Indy market and into the Midwest, where rents for commercial property are extremely low and labor is plentiful and extremely low in terms of cost. As far as top employers go, you definitely can see the healthcare and the education. One of the ones I was shocked on there is that Rolls-Royce has 4,200 employees. It must be selling a lot more Rolls-Royces than I see out on the road, and I think I need to get myself one at some point. But as far as Simon Property Group, Anthem, and Eli Lilly, these are massive companies, right? A part of the Fortune 500. And something I learned in my recent research is that there's actually a Fortune Global 2000. And that Anthem, you know, the healthcare insurer, a lot of people are insured with Anthem Blue Cross. And Simon Property Group is a huge REIT. They're a part of that Global 2000. And if you're not familiar with Simon Property Group, huge REIT, the largest holder of Simon Property Group is Vanguard. So if any of you guys are out there, Vanguard investors, you know, good priced mutual funds, they are, again, are the largest holder in Simon Property Group and a huge believer in that firm, anchored in Indianapolis. Okay, tech, huge thing that's happening in Indianapolis, and one of the major reasons I see and that we here at Marshall Reddick believe that Indianapolis is the right market to get into. You know, you don't really think of Indy as a tech market, but Brookings did a study recently that was very interesting and found that Indianapolis is kind of an anomaly when it comes to tech. And I touched on that a little bit before, and a lot has to do with that manufacturing employment base that they have, coupled with the education, the higher education levels they have. So there's all these higher education firms that are starting to offer these programs that are training this labor force into what they call mid-tech jobs, which are defined as computer and mathematics jobs that require less than a college degree. So these are very, very fast growing, and there's so many tech companies out there that are hiring these types of jobs. So you're going to start to see large anchor companies, as we have. I'm going to show you a couple of those who are really moving into the Indy market. But again, loving data, check out the growth in mid-tech jobs from 2012 to 2016. Obviously, San Jose anchoring the Silicon Valley up at #1, but Indy comes in #5, right, at 5.6 annual growth rate for these types of jobs. That is going to continue to rise, folks. So as I mentioned, some of the big anchors coming in. So Salesforce, big one that everyone's familiar with, right? Bay Area CRM company, customer relationship management. I mean, every business uses a CRM these days, and these guys are kind of pioneering it. So they bought, I think that is this 2016 Exact Target, which was a large Indianapolis-based firm that allowed them to get into that market for $2.5 billion. So we're talking about major investments from tech companies coming in. Another one, Genesis, yet another California company coming in to buy Interactive Intelligence, another technology company based in Indianapolis for $1.4 billion. So these are these anchor firms coming in, and they're bringing great talent with them, and then that talent spawns off and starts up smaller tech companies. And then what does that do? That brings in major investment from these tech investors who are looking for the next Facebook or Twitter or something like that that's going to boom, right? And all of this just brings dollars and jobs and population, which translates into large increases in building, which increases rents, which increases property values. All of the things that you as rental property investors want to look for. These are just some of the articles that I read, Daniel and I read, in terms of getting a lot of this data together for the presentation tonight. So again, I've got my sources there at the bottom. And a couple specifically that I wanted to point out that I really recommend you check out. This one here, the Unexpected Tech Hub. This was published by Colliers, which is a large commercial real estate services firm. And they are talking about the dynamic about how cheap the commercial real estate space is in Indy and why that's bringing a lot of the big jobs and big employers there. Another one that I'd like you guys to check out is this article that was published in The Economist, right, talking about the tech scene that's growing there. And one of the cool things that I thought about this is it brought to my attention is that some of these job recruiters like ZipRecruiter or like Indeed, these companies are becoming huge data companies because they're starting to see where jobs are being posted, what types of jobs are being posted there, what the pay is for those types of jobs. So ZipRecruiter is one of those, and they listed in this article was cited as saying that Indianapolis is the #6 in the country up-and-coming city for tech jobs. So again, what I'm telling you guys, what's happening in Indianapolis is more than a renaissance.
All right, we're going to talk briefly here about financing, how you're going to be able to acquire an investment property. So I want to introduce you all to our preferred conventional lender, Reed Hazard at AmeriFirst Financial. We've been working with Reed here at Marshall Reddick for, as you can see there, 14 years. Reed is a direct lender, very knowledgeable, especially in terms of investment property. But here's the real kicker. He is licensed in every market Marshall Reddick operates. And how is that beneficial to you? Well, Reed's going to provide you with a pre-approval letter, and I'm going to show you an example of that in a second. And that's going to be your golden ticket. That's going to be how you're going to be able to submit an offer on any investment property you pursue.
All right, it's a huge benefit not to get pre-qualified with a new lender in every state in which you're considering investing.
Exactly.
What a time saver.
Exactly. And that's what Reed's going to be able to do for you specifically as a Marshall Reddick investor. I truly believe that companies that work together need to have values that are aligned. And just like Marshall Reddick Real Estate is heavily invested in technology, so is Reed. And his pre-approval process is seamless. It can all be done online. His website links to your bank accounts. Much of the documentation and information you need to submit to your lender can be done very seamlessly through his website. Reed is very quick in his pre-approval process, and once all of the information and documentation that he needs from you to process your pre-approval is collected, we'll get our, like I said, golden ticket. A fully underwritten approval, almost as good as a cash offer when we are submitting offers on any investment property in any market that you're interested in investing.
Cool. Yeah, I've done some loans with Reed, purchase and refinance loans, and I can definitely tell you that it's worth it. So as far as our rent-ready system and turnkey properties that we're offering, let's dive into that. Specifically, again, I want to make sure that everyone understands that we're buying property. So Marshall Reddick would be the owner of the property. We renovate, so we've got access to the contractors. We're taking on that risk, right? You never know. Every renovation always has a higher rehab budget than you thought. So again, we're taking on that risk. We stabilize the property, and then ultimately we're going to be the seller of that property. But you'll have your own independent advisor, your real estate agent who will provide your own representation. He will be there for your inspection, be there for your appraisal, and all of those things as a regular arm's length transaction. You're going to get to benefit in this program from our knowledge, our experience, and our relationships, right? Again, which we've built over the last 40 years. And the system is controlled, so it's very low stress, right? You're not going to be competing against 1,000 other offers, and it's passive. And again, it might not be for you, right? But a lot of folks really prefer to go in this turnkey process. And one thing that I can say that differentiates us from a lot of quote-unquote turnkey providers that are out there is that we're going to be offering you the property still with an equity position. right? Not like the Memphis Invests of the world who are going to be out there advertising that their turnkey product is going to be anywhere from $10,000 to $20,000 over market value, right? So we're going to take the risks. We're going to provide it to you in a passive fashion, and we're also going to give you an equity position from day one in that property, allowing you to collect income from day one due to the fact that the property will already be rented. We target certain types of properties in this, and we do so because we have learned that certain types of properties are going to be better long-term rentals. Specifically in Indianapolis, single-family homes. There are multifamily there, but a lot of the multifamily is not in the greatest neighborhoods. As far as single-family homes go, I'm a big advocate on that front too. You're going to get long-term, nice tenants, usually young families with kids, and what does that mean? They stay longer. Multifamily tenants stay for sometimes not even 12 months, but the multifamily tenant who stays longer than 12 months is non-existent. So again, on the single-family home sales front, we're talking about 3 bedrooms or more, 2 baths or more is ideal. We will entertain the 1.5 bath for the right property. Minimum 1,000 square feet. Garage is preferred, but not a deal breaker. And we prefer no basement. A basement's okay, but we prefer no basement. And the reason we prefer that is because it's going to be less maintenance and the insurance will be lower. Your insurance costs will be higher for homes with a basement. Okay, but basements are pretty common in the Midwest, and you find those in Indianapolis, especially on older homes. But newer homes are moving away from having that basement. Otherwise, it's not a problem to have it. And I certainly think that if I owned a home, I'd like to have a basement. It's kind of like a man cave, but we don't have those here in California. So anyways, newer homes are better, again, my opinion. It depends on the rehab job, of course, but the newer the home, ideally, the less maintenance you're going to have because it's newer. It's built to better standards. It's built to higher codes. So we try to focus on 1950 or newer. We will go lower for the right deal, but we'd even like to be built in 90 or later, or even 2000 and later. Price point wise, 85 is going to be kind of our bare minimum. We really don't want to get into anything that's going to rent for less than $800 a month. You're just going to have too much maintenance and vacancy to stomach it. Right? You want to invest in property that's going to be passive. You don't want to deal with the evictions. You don't want to deal with tons of maintenance on your property and having to repaint and carpet and all these things after every tenant turn. So the nicer the property, the nicer the tenant, the better experience you're going to have. So again, the target that I like to get into is going to be the $85,000 to $155,000 resale price. That's going to give us the best opportunity to hit the 1% rule. Right, and if we can hit 1% of the monthly rent to equal 1% of your sales price, right, you are going to be in a very good cash flow position. So as far as our Marshall Reddick pro formas go, those that know us, we're very heavily and very transparent in terms of our maintenance and vacancy costs. So I'm targeting to be able to provide monthly income of plus $300 a month after all expenses, right? And plus 10% annual return on investment. If I can hit those numbers in this turnkey program, you guys are going to have an excellent experience and be back for a second within 24 months. So back to our heat chart, that price point that I'm talking about is going to kind of fall right here. And it's going to be kind of from that lower A class down to our upper C class. So again, turnkey might not be for you, and I get asked a lot of times, I know Daniel does, in terms of buying wholesale and doing the work yourself. It's certainly possible. Or for those bigger pockets folks that are out there, and the term BRRR, I believe that stands for buy, renovate, rent, and refinance. These types of things are possible. But it's difficult for folks that are out of state doing that, right? And it's risky. It's not recommended for anybody with a day job. And I say that because those with a day job and a family, again, you don't have time. You're not in the business. You don't have the hours and hours daily to make sure that you're not getting taken advantage of. Because that's what the problems that you're going to expect. When you go into a market like, let's say, Indianapolis, and you live in California or someplace that's not Indianapolis, there are tons of crooks out there looking to capitalize on California investors. I kid you not, right? You get somebody in the 317 area code, that's Indianapolis, gets a phone call from somebody with a 213 or a 310 or a 714. They literally see dollar signs, right? I have experienced it because I have bought many properties over my 15-year career with Marshall Reddick, and I just want to share that knowledge with you guys. You don't understand the market and you don't understand the no-fly zones. So you don't want to get caught buying something in an area that's not going to be a good long-term investment. If you're buying wholesale or you're doing something creative, you need access to cash, which, you know, folks that are buying rental property, that's one of the best benefits of it, is that you can use leverage, other people's money, right? And use that use that conventional money at the lowest down payment and the lowest interest rate possible. So trustworthy contractors, that's big. Again, these are just some of the pitfalls that you're going to run into if you choose to do something a little more creative. Not recommended, especially for the day job and for those folks who are on the front end or very early on in their investing career.
Okay, we're going to touch on property management again just a little bit. Red Door Property Management are preferred property managers in Indianapolis. Like I said, they manage a portfolio of Marshall Reddick clients' property, offer discounted rates for Marshall Reddick clients. Mike Taylor, who we introduced a little earlier, is the owner, but I want to make sure to highlight what it is your property manager does for you. Your property manager is going to take care of your asset, your investment for the life of your ownership. They are going to place your tenants. They are going to handle the background checks, screenings, the showings, the maintenance requests, among other things. So it's really important to work with a property management company that's transparent, that's honest, that don't have conflicts of interest, who really has your best interest at heart. This is just a snapshot of Red Door's website. You can see interactive. Everything's done online. That includes yourself as an owner and for the tenants as well. Your tenants have a portal. Here's the discounted fees available to Marshall Reddick clients with Red Door Property Management. 60% leasing fee, 8% monthly management fee. And I just want to highlight something very quickly. With the turnkey investment property that we're going to be showcasing in just a moment, you actually don't have to worry about the 60% leasing fee to place a tenant for a vacant property because we've already placed the tenant for you.
Well, Red Door's placed the tenant for us, but we've already paid Red Door for the 60% leasing fee. So again, huge benefit, right? We're talking about higher rents at $1,300, $1,400, $1,500. I mean, that's a $700, $800, $900 expense that you don't have to bear right out of the gates. Again, because we've already had Red Door engaged with the rent-ready property, tenant in place, etc. And I'll add to what Daniel's saying about Red Door. A big thing that I see a lot of times in property management these days is the upcharge on maintenance. And that simply means like they're going to handle maintenance calls for you, and they're just going to call another contractor or you know, a carpet cleaner or whatever. And if that bill is $100 and their maintenance upcharge is 10%, well, the bill to you is going to end up being $110 as opposed to what it actually is to the firm. So Red Door is one of those that we align with that does not charge an upcharge on maintenance. Be aware of that in other markets and in other property managers that you may be working with. As far as technology goes, you know, Daniel hit the nail on the head, right? We believe heavily in it. We invest heavily in it. And that's one of the reasons that we've aligned with Red Door, right? They're very much technology driven, right? So they do video inspections every time you have a vacancy so that you can see all the rooms, you can see if there is damage, that type of thing, right? Tenants are required to pay online. Very seldomly does that happen in other markets. And what is that going to do? That's going to ensure that you have tenants that are a little more sophisticated, that have the ability to pay online. I mean, that sounds kind of funny, but you'd be surprised in a lot of lower end properties, the tenants are paying with money orders, right? And so the fact that we require them to do it online, that means they have to have bank accounts. And again, it allows them to be very selective on the properties they will manage. Again, aligning with us, ensuring that we're in good neighborhoods with good school districts and going to have good tenants. Additionally, you know, all the owners are paid direct deposit. It's a paperless office that they run, so don't expect to get mail. DocuSign for everything. So your management agreement, you're not going to print something out, scan it, and fax it back, or whatever you need to do, right? It's going to be done electronically, which saves everybody time. And if you're familiar, worked with other property managers, they use AppFolio. Very good system, very easy to use. Everything's right online. All of your bills, all of your invoices, etc. As far as insurance goes, Stan Dreckman insures all of our turnkey properties. We've worked with Stan forever, and you know the bottom line is, it comes to insurance, it's got to be cheap and it's got to be good. And Stan hits both of those, right? We don't just use Stan just because. We use him because he's the fastest, he's the cheapest, and he offers the best coverage. Usually the coverage is through Safeco, but he does have access to other markets. Quickly speaking, you know, the purpose of having insurance is to save your save your loved ones from financial loss. It's liability coverage, right? It's just an absolute must. And of course, if you use financing, the lender is going to require you to carry homeowners insurance. As far as insurance, though, we're going to get into our properties here in just a second, and one of them is this property on Hayford. So I actually wanted to show what the insurance policy would look like so that you guys can see that it's very good and it's very cheap. Because in a lot of markets, taxes and insurance will play heavily into your cash flow, right? That's one of the reasons we like Indy. We can get decent property taxes and very low insurance, okay? So in this particular property, we're talking about an annual premium of only $675, which translates into $56 a month if you prefer to look on it on a monthly basis. And this is for a full replacement cost policy, right? So Safeco believes that to rebuild this property, it's going to be $183,000, far, far more expensive than the sales price to you today.
All right. One thing I want to highlight as well is that we have market data packets available for every metropolitan area that we're in outside of the state of California. This is part of the Marshall Reddick philosophy of providing the education to you as the investor for free. Save your hard-earned money for the investment itself. You can see the link to access this market data packet that's going to give you a basic overview of the metropolitan area. You'll see that below, but if you email me after the webinar, I'll send you the PDF copy as well for Indianapolis and any market that we're in. We touched on a lot of these points already, and we'll continue discussing these today throughout the webinar, but why invest in Indianapolis in general? Well, Indianapolis is, like Pat had mentioned, a very stable market, especially in terms of appreciation. Not a lot of volatility that we may be accustomed to here in California or in more coastal areas like Florida as well. But Indianapolis really has a very favorable price to rent ratio. And why is that important? Well, that's the most important metric in determining your cash flow or your cash on cash return. Why is that? Well, your rent, of course, is the source of your income in owning, your passive income in owning investment property. But it's not free to own investment property. You have fixed expenses on a monthly basis. And the higher the price that you pay for your investment property, the higher your mortgage, then you have to pay taxes, insurance, etc. And your rent has to cover all of those expenses. So if your rent is higher and your price is lower, well, then you have less expenses to cover with the rent that you're collecting, and more of that money is going to be passive income, or in other words, cash flow. So this is the part of the presentation that most of you have been waiting for tonight. We're going to dig into currently available turnkey inventory. And there's a few things I really want to highlight before we dig in here. Every property that we're going to showcase tonight is going to reflect a price lower than what you're going to see on the website. And that's to the tune of a $5,000 reduction in purchase price. Exclusive for all of you who have joined us on the webinar tonight, and that offer is going to remain valid for the next week. That's correct, right, Pat?
Yeah, right. So the price on the website is the ask price. But again, as Daniel mentioned, specifically for those who took the time to be with us tonight, we're offering a $5,000 reduction in price, and that will be good for contracts written through September 7th. So that's a week from this coming Friday. So if you're interested and you're ready to go, this is something that you want to take advantage of.
And that's not to mention the 1% closing cost concession that will be included with a full price offer as well. All right, first and foremost, we have 10348 East 25th Street. Beautiful turnkey home. This is my favorite home that we're showcasing tonight. The reason being that it's actually fully rented already at $1,095 a month. Tenants in place, and it is our lowest priced property that we're going to be showcasing this evening, and really highlights what we had been discussing earlier, that rent to price ratio. Very briefly, I want to showcase some of the aspects of the pro forma here that we're taking a look at. Ultimately, as your real estate advisor, one of my favorite things to do is go through a pro forma or through the financial calculators with you line by line, and show you what each of these figures represent and how they're calculated. But I want to show you and highlight one of the benefits of a turnkey property. Not just that this property has been completely renovated, not just that this property already has a tenant in place, but one of the benefits of investing turnkey is mitigating risk associated with investment property. Two of our biggest risks in investment property are maintenance and vacancy. And with a rehabbed property and a rented property, you don't have any of that initial maintenance and vacancy, meaning more of your monthly income or more of your rent is going directly into your pocket, and you will have less of those variable expenses.
I got to disagree with you. Although I do like this property a lot, Daniel, and I think that it's desirable because it's at that price point that's just a little bit above 100. I think I'm liking a little bit higher price points, and let's get into one of those other properties. First, before we do that, though,
we'll just look. Pat already hit the nail on the head a little earlier as well. One of the biggest drawbacks from turnkey properties for a lot of investors is that these properties are purchased by a company, rehabbed, and sold at a markup. That's not what we do here at Marshall Reddick. We price our properties because we know we're selling to investors at market value or just below, so you do have some equity. And how do you know that's what you're getting? Well, we provide the comparables for you for these turnkey properties to review, and they do appraise.
Yeah, just again, don't want to notice on the screen here, we're looking at the subject property we're talking about is this property on 25th. So all of the properties, all of our turnkey properties on the website will have the same type of comps here, price. We also provide the rent comps, right? So the gray on the front end will be the subject property. And you'll notice that the price here is $117.9, whereas on the Proforio it's $112.9. That's reflective of the $5,000 price reduction that's being offered specifically for those folks who joined us tonight. Okay, moving on to the second property, still not my favorite, but another good one.
Yeah, I want to highlight one thing here, Patrick, for everyone and all of you on the webinar tonight. We discussed earlier Indianapolis, a very stable, appreciating market year over year. And we saw that appreciation was about, on average, 2.15% over the last 25 years. And here we have 1.6% reflected. And you might be saying, you know, where's the discrepancy? Well, keep in mind, this is a B-class property. Marshall Reddick Real Estate, our investment philosophy is to be very conservative, under-promise, over-deliver. That's why our maintenance and vacancy reserves are among the highest in the industry as well. But essentially what we're saying here, lower class neighborhoods appreciate at a lower rate than neighborhoods of higher class. So the lower the property class, the heavier we adjust the appreciation trend, and that's what's ultimately factored in our projected profit. So keep in mind that this annual ROI, this projected profit, is factoring in an annual appreciation below the metropolitan average, and is factoring in heavy reserves for maintenance and vacancy.
Yeah, absolutely, Daniel. Very important to stay conservative, and we've learned that over the years. So we firmly believe that these numbers are as close to accurate as can be possible. So in this particular case, over a 15-year period, we would suspect that on this property, your take at the end would be $77,788.96, right? Again, factoring in appreciation, accumulated cash flow, and selling expenses. What other company out there is going to even include that in their pro forma? Again, quickly, just again, all of our turnkey properties will offer comps. I fully encourage you to do your own research and to do your own due diligence in terms of comping this out. Can easily be done online these days, or can easily be done with a phone call to a local real estate agent. You could ask Christopher, our real estate agent, who will be your real estate agent, about it as well, but they're all going to be looking at the same group of data, and it's very easy to know whether the property is priced correctly or not. Furthermore, if you're using a loan to buy, which most folks are, you're going to have a required appraisal, and the property will have to appraise for value, okay? So again, it's all about transparency with Marshall Reddick in terms of price and in terms of rent. We want you guys to have a fantastically amazing experience with the turnkey properties so that you're back for the next one as you continue to build your portfolio. So Daniel, this is my favorite, right? And I like this one the best because of two reasons. Number one, it's at that price point that's going to start dipping us into the A-class range, which is going to give me the higher appreciation. So we can see this one, we're applying that 2.15%, which is that average number over a 30-year period that Indianapolis has experienced. Right? Those numbers are published by the National Association of Realtors, right? So what does that mean, right? A property built in 2000 is nearly new. So we're going to have very low maintenance. You can see that this one is applied in the pro forma at 8% maintenance and 8% vacancy. With higher appreciation, what does that translate into? That translates into more money, more profit for you as the investment property owner. So yeah, you have to invest a little bit more capital, not a lot. I think that, you know, the first two we showed are about 30,000 investment. The second one's about 40,000. This one's dipping into the 50,000. But in terms of what your return on investment over the long run, we truly feel that the higher class properties are going to be the better investments over the long haul.
Pat, I just want to highlight something here for everyone on the webinar tonight. Take a look at what's included in a rent-ready package in your turnkey investment property. New flooring, new paint, new appliances, a new kitchen counter, refinished cabinets, and more. Think about all the big-ticket items in an investment property, the maintenance expenses that you may occur over time. Really, the benefit of a turnkey property is that we're addressing those issues right away. So you experience less maintenance over time.
Awesome. Absolutely. And again, so and everyone can see, here's our price comps to support that value and our rent comps to support that value of that property. Again, my favorite on 54th. So beautiful. Back to Monument Circle in Indianapolis, where we got started, kind of coming full circle, if you will. We're going to take one more poll question, and then we're going to address some questions that have come in before we wrap up for the evening.
All right, we'll launch the poll here in just a moment. So this is relative to the properties we showcased tonight. The property that I'm most interested in is, first we have East 25th, Hayford, West 54th. And then lower price property, please, less than 100,000, or higher price property, please, more than 200,000.
Again, we love crowd participation. We take our presentations extremely serious, and we love feedback. So this helps us get better with every transaction. We'll give you just a couple more seconds there, and we will get this closed. I love publishing the results too. I think that that's great feedback for you guys to be able to see as well. All right, so we're going to close the poll and share the results. So pleasantly surprised, Daniel. I think that the crowd,
about half,
yeah, nearly 50% shares, you know, my thoughts in terms of that property on 54th Street. I'm imagining that property is going to move extremely quickly, but I don't think we're going to hold the others much longer either. All right, well, as we wrap up, just to make sure that everyone's aware, always go conventional in terms of financing if you can. But there are certain instances where you might not be able to, right? A couple of those instances would be if you're using a self-directed IRA to purchase. If you want to do that, you either need to have cash or you need a non-recourse loan. That's an instance when you might need private financing or private lending as provided by Marshall Reddick. Another scenario would be where the property, the loan that you're looking for maybe is sub $50,000. Banks today and financial institutions just do not make loans of under $50,000. There's just not enough money in it for them. That's a situation where you can come to Marshall Reddick for private financing. Or another one is just simply Fannie Mae and Freddie Mac guidelines. A lot of our folks have more than 10 mortgage properties. I personally am in that situation. I have more than 10 mortgage properties. Therefore, no matter how high my FICO score is or how much cash I have in the bank, I cannot qualify for a conventional mortgage. Therefore, as I continue to buy and I continue to invest using leverage, I need to use private financing. So keep that in mind. Just wanted to share with you guys that we do offer that type of program, and here is what our private rates look like. Again, an LLC can use this and borrow directly, a corporation, or a self-directed retirement account. Additionally, Marshall Reddick also offers fix and flip or fix and refi programs. So these may be for a little bit more sophisticated investor who doesn't want to buy turnkey, who maybe wants to buy something wholesale, or maybe wants to buy something that's distressed and fix it up on their own, and they want to use leverage at very high loan to values and higher interest. Here is our short-term fix and flip programs offered to investors looking to do something a little more sophisticated.
All right, thank you so much for joining us, everyone. We'll take a quick moment here, open up the floor to all of you for questions. Citizen Interactive, so feel free to type in the chat box, let us know if you have any questions following tonight's presentation.
Yeah, we've got a good one coming in. I think it's revolving around the private financing I just showed. The question is, can I get a loan using an LLC, right? And then I guess the second question to that is, and I mean using a conventional loan. So the answer is you cannot get a conventional loan to an LLC. Right? What people do sometimes in that situation is they get the loan personally and then they change the title and move it into an LLC. However, a conventional lender will not loan money to an LLC. And the reason is conventional financing is very much based on FICO score, and LLCs do not have FICO scores. Now, if you need private financing, we do not care about FICO scores, right? We care about property cash flow and down payment. Right, so that in mind, if you're looking to borrow in the name of an LLC or, like I said, a self-directed retirement account, you can do that with private financing as provided by Marshall Reddick.
Patrick, there's a couple questions here that I want to address really quickly. Is this presentation going to be available to us? Yes. This presentation has been recorded, and any of you who would like a recording, you can access it directly on our website. You can ask me to send you a copy of the recording, so you will be able to review the data that's been presented again. And then there's a question here, is it usual to charge higher rent each year to at least cover inflation? That's a great question, and that actually highlights on why it's important to work with a knowledgeable property manager, because essentially, yes, every year every time your lease renews, you have the opportunity to raise your rent. But how do you know if you need to raise your rent? Well, it's your property manager's job to stay on top of market rents and determine whether an increase in rent is justified, and be able to help you make that determination as well.
Another question coming in, how often do we have properties that have tenants in place already? So we don't have a huge inventory of these rent-ready properties, these turnkey properties, but we try to keep a consistent supply of them. So right now we have 3 available. We showed them all to you tonight, and we've got at least 5 in the pipeline. So again, we're not going to have a huge supply, but specifically if you're looking for something, you can obviously touch base with Daniel, and we can go headhunt and find you the exact property that you're looking for. Otherwise, we will put you in the queue, and when the next one comes available that fits your criteria, again, working with Daniel, he will let me know, and we'll make sure that you're in line as, you know, first right of refusal for the next turnkey coming available. Okay, I think we've got a question, Daniel, about the profits and the return on investment. So that's very important, I think, to address in terms of transparency and how things work on our website. So I want to jump back up on the pro forma, and I'm going to let you answer that question.
Sure, absolutely. And I will. I'll explain here what both of these numbers mean. And
so we're talking about down here in the bottom on the screen, guys, the 15-year projected profit and the annual return on investment. So we've had an investor ask us what is comprised of these numbers and or how are they calculated?
All right. So first and foremost, our investment calculators default to a 15-year hold. That's adjustable, but we found on average investors hold their investment property about 15 years. So this metric, this $100,000 return that you're seeing, is saying that you're going to experience a return on your investment, a profit essentially of $100,000. Now, what's included in that $100,000? Well, first and foremost is your cash flow over 15 years. So that's this figure here, this $170 a month after maintenance and vacancy, mind you, times 12 for your annual cash flow, times 15 for your cash flow over 15 years. Then we're factoring in this appreciation trend over 15 years. So the amount your property appreciated over 15 years based on 25-year historical data. Then we're also factoring in principal paydown. A lot of investors forget to consider that every month you're paying down principal on your mortgage.
Which is doing so with tenant rent.
Exactly. So really your tenant is building equity in the property for you. So those are the 3 main returns that you're seeing in owning investment property. However, it's important to note that appreciation and principal paydown are realized once you sell the property. So then we subtract selling expenses. We estimate that to be 9%, real estate commissions and closing costs. And that's where this $100,000 is coming from.
Yeah, and so when Daniel's saying 9% in terms of the disposition or the sale cost, for easy numbers, guys, let's say that we're talking about a $100,000 property. If you're going to sell that and you sell it traditionally with real estate agents, we're expecting your sales cost to be about $9,000. So you would realize $91,000 after selling a $100,000 property. So again, the 15-year projected profit at $100,000 is a summation of accumulated cash flow, right? Your appreciation, your principal pay down, less your selling expenses. And then Daniel, how does that 15-year annual ROI come in?
Well, that's a great question, Patrick. So this is essentially reflecting your profit as a percentage annually. So you see here, of course, your projected profit is $100,000. If you divide that number by your initial investment, remember your down payment with your closing costs, then divide that number by your holding period, your 15 years, you end up with this percentage. Of course, multiply it by 100, so you get a percentage. But you're essentially saying that every year that you hold the property, you are seeing on average a 13% return per year.
And again, with heavy maintenance and vacancy and our very conservative annual appreciation rate. So these are real numbers, folks.
Absolutely, Patrick. And just remember, everyone on the webinar tonight, we sort of briefly passed through those metrics. I am happy to go into much more detail regarding the calculator, how those numbers are calculated, etc. So in order to do so, I spoke with many of you today, but I'll be following up after this webinar with all of you, getting to know you a little better, answering your questions. But I wanted to make sure that you had my contact information available immediately. If you would like to speak in more detail about Indianapolis, about any market, about investment opportunities available, go ahead and shoot me an email, give me a call. Let's schedule initial conversation. It's no obligation, but it'll at least point us in the right direction. And especially if you're interested in one of the properties we showcased tonight, please do reach out as soon as you can.
Awesome. Daniel, thanks so much for joining me tonight, or I guess suppose letting me join you tonight.
Yeah, thank you so much, Patrick. I really appreciate it, really did enjoy the webinar. And thank all of you investors that joined us tonight as well. Hope you enjoyed it.
Thanks again. You guys take care.